Out of the Reference Guide to Regulatory Compliance, I'm reading about interagency guidance on predatory lending. In subsection 3, guidance referred to as avoiding predatory and abusive lending practices in brokered and purchased loans. This was issued in 2003. The purpose of the advisory letter is to alert national banks to the risks they take if they offer loans through brokers or purchase loans that contain or reflect abusive or predatory terms or practices. The practices covered are traditional broker transactions in which a mortgage broker refers an application to the bank and the loan is closed in the bank's name. Table-funded loans are that are closed in the name of a third party, but in which the bank provides a loan, funds, and immediately acquires the loan. Loan purchases in which the bank purchases the loan from a third party after it is made. Those three are examples. So table-funded, traditional broker transactions that are closed in the bank's name, and loan purchases in which the bank purchases the loan from a third party after it's made. That's really only three ways that loans make it to the books. Risks of predatory lending is your credit risk, legal risk, and other risks. Your credit risk, for example, are loans made without regard to borrowers' ability to repay without resorting to foreclosure or collateral. Predatory loans have a higher foreclosure rate and are not consistent with fundamental safety and soundness. Legal risk is predatory and abusive loans that will subject a bank to supervisory action and civil liability under truth in lending and the right to rescind, RESPA, HWIPA violations, fair lending violations, and violations of the FTC. Other risks include reputational risks and adverse effects on the bank's CRA rating. Recommended practices. Establish policies and procedures for acquiring loans through brokers and purchasing loans in general, entering into and continuing relationships with third parties, mortgage brokers and originators, and standards for underwriting and appraisal requirements, determining when the bank will purchase loans with one or more features that have been associated with abusive or predatory lending practices, the maximum points and other charges that may be imposed on brokered or purchased loans, and broker compensation limits. Those are all issues that should be covered in policies and procedures. One more, strong and appropriate controls over all mortgage origination functions. Furthermore, the recommended practice is to perform due diligence before entering into third-party relationships, including a review of the third party's general competence, business practices and operations, reputation, financial capacity, internal controls, and record of compliance with laws. Another recommended practice is having written agreements with third-party brokers that specifically and clearly address the rights and responsibilities of each party. Written agreements should ensure that no inappropriate compensation exists and provide for indemnification to the bank. Enable banks to exit the arrangement through a termination procedure and provide for the banks and the OCC's ability to access all records of the third party and to audit the third party's operations. Fourth, verify that brokers and originators have established policies to ensure that loans will comply with all applicable laws. And fifth, conduct documentation reviews. Sixth, recommended practice is establishing an effective management information system to monitor the performance of third-party brokers and originators. And seventh is to take corrective action when necessary. FDIC payday lending guidance, safety and soundness, with regard to safety and soundness, was issued and covered in this section. State non-member banks payday loans are defined here. State non-member banks covered under the FDIC payday lending guidance are banks that have payday loan programs that they administer directly using their own employees and banks that enter into arrangements with third parties in which the bank funds payday loans originated through the third party. Payday loans, specifically, are small dollar, short-term, unsecured loans that borrowers promise to repay out of their next paycheck or regular income payment, including Social Security checks. Usually priced at fixed dollar fees that translate into high annual percentage rates. They're also called deferred deposit advances. Borrowers often provide a posted check or debit authorization for the loan plus the fee. The lender collects the loan by depositing the check or debiting the borrower's account. If the borrower cannot repay the loan, the lender will often refinance the loan into an additional fee will be paid. The payday lending guidance issued by the FDIC does not apply to banks that make occasional low-denomination short-term loans to a customer, and the guidance covers examinations of state non-member banks, and it's therefore applicable to FDIC examiners. Let's see. Significant risks of payday lending include borrowers with cash flow difficulties, borrowers with no lower cost credit alternatives, minimum analysis of borrower's ability to repay the loan, minimal review of the borrower's credit history, and credit is usually unsecured. The procedures for the examiners, procedures set forth in the FDIC subprime lending examination procedures are applicable to payday loans. Examiners should also examine appropriate third parties if necessary, including review of staffing and compensation practices, marketing and pricing policies, compliance with bank policy, management information systems, compliance with outstanding laws and regulations, and testing of individual loans for compliance with underwriting and loan administration guidelines, treatment of loans under delinquency, and re-aging and cure programs. Arrangements with third parties should be examined. Written agreements should describe the duties and responsibilities of the parties, scope of the arrangement, performance measures or benchmarks, responsibilities for providing and receiving information, specify arrangements with third parties that should be examined, should specify the third party must comply with all applicable laws and regulations, and specify which party will provide compliance-related disclosures. And these written agreements should authorize the bank to monitor the third party and review and verify compliance with the agreement. The written agreement should authorize the bank and the banking regulatory agency to have access to records of the third party and conduct on-site transactional reviews. The written agreement should require the third party to indemnify the bank for potential liability resulting from actions of the third party and address customer complaints. Examiners should determine that banks are sufficiently monitoring the third party with respect to its activities and performance, including its financial condition, its controls, and the quality of its service and support. Safety and soundness issues under the FDIC payday lending guidance are concentrations of credit, capital adequacy, ALLL, classification guidelines, renewals and rewrites, accrued fees and finance charges, and recovery practices. Under concentrations of credit, we know that a bank should have less than 25% of its Tier 1 capital concentrated in payday loans, or it will be criticized for failing to diversify risks. Under capital adequacy, the minimum capital requirements are not enough to offset the risk of payday loans. Banks should hold capital against its subprime portfolio in amounts that are 1.5 to 3 times greater than normal. Under allowance for loan and lease losses, which again I'm explaining all safety and soundness issues, for banks must maintain an ALLL adequate to absorb estimated credit losses from payday loans. Banks should evaluate the collectability of accrued fees and finance charges on payday loans and ensure that this income is appropriately measured.
Don't forget to lock your car, honey, so I don't forget to remind you.
I think it's locked. Oh, it's locked.
It is? Okay. And don't leave your computer on this back porch, okay?
Okay.
And does your dog have water in its bowl before the night?
No, she just drank it all.
Okay.
Let me finish this one section. I'll be right in.
Watching a real good show.
Okay. Classification guidelines. Payday loan portfolios should be classified as substandard. Payday loans outstanding for more than 60 days from origination should be classified as losses. For renewals and rewrites, the bank must have standards for renewing loans, including a limit to the number and frequency of extensions, deferrals, renewals, and rewrites. A prohibition for additional advances to finance unpaid interest and fees, and procedures to ensure that risk management reporting and internal controls are established and maintained. For payday loans, the bank also should have cooling off periods between repayment and obtaining a new loan, a maximum number of loans per customer within 1 calendar year or other designated time period, and a rule providing that only one payday loan may be outstanding for one customer at any time. Accrued fees and finance charges. Banks must evaluate the collectability of accrued fees and finance charges. After the loan is placed on non-accrual, subsequent fees and finance charges imposed on the borrower should not be recognized as income. For recovery practices, amounts credited as recovery on a loan must not exceed all principal, finance charges, and fees previously charged off. Amounts that exceed these must be credited as income. Compliance issues under the FDIC payday lending guidelines explain that under the Community Reinvestment Act, payday lending may adversely affect the bank's CRA rating. Any illegal or questionable practices will negatively affect the bank's CRA performance. A payday lending program may be inconsistent with helping to meet the needs of communities' credit needs. Helping to meet the community's credit needs. TILA, the bank or its third-party partner must properly disclose all finance charges and fees to payday lending customers. Advertisements of the program are also subject to tooth and lending requirements. ECOA, illegal discrimination can occur if the bank has a payday lending program as well as other short-term credit products. How the programs are marketed and how pricing is set are factors that determine whether there is an ECOA violation. Adverse action notices must be sent to applicants who apply for payday loans but are denied. The Fair Credit Reporting Act, adverse action disclosures must be provided to applicants of payday loans that are denied if a consumer report, including check tracking services, was used in the credit decision. Under EFTA, compliance issues are if the payday lending arrangement involves opening an account, creating an electronic fund transfer, or EFT, appropriate disclosures must be provided. For fair debt collection practices, risks include whether the bank uses a third party to originate the payday loan. The third party is subject to the Fair Debt Collection Practices Act and the bank may face reputational risk if the third party does not comply. The FTC Act for unfair and deceptive practices in marketing and collecting payday loans are of a particular concern, particularly the practice of threatening criminal bad check charges despite the payment of a fee and the lender's knowledge at the time the check was taken that there were insufficient funds to pay it. Privacy of consumer financial information. Payday lending arrangements are subject to the same information sharing restrictions as other products and services. Consumers must receive a copy of the bank's privacy notice both at the time of the transaction and annually. Safeguarding customer information. A payday lending program should be addressed in the bank's written information security program. On page 27, guidance on non-traditional mortgage product risk. And I have to get through that guidance in the next recording.